Financial statements represent a formal record of the financial activities of an entity. They are prepared for a range of stakeholders, allow for the basic function of a business, and assist management in making decisions for the business. Accountants summarize the results of business activities into 4 financial statements: the statement of comprehensive income, the statement of changes in equity, the statement of financial position, and the cash flow statement. The statement of comprehensive income, or the income statement, answers whether or not the business is profitable. It presents a summary of the firm's revenues and expenses for some period of time, such as a month. It follows the structure of revenues minus expenses equal net profit. Net profit is reported if total revenues exceed total expenses, and net loss occurs if total expenses are greater than total revenues. The statement of changes in equity conveys the growth of equity as a result of profitable operations and the distribution of equity in the form of dividends. It follows the structure of beginning balance, add net profit, less dividends equals ending balance. It presents a summary of changes in owner's equity during the same period as the income statement. The statement of financial position, commonly known as the balance sheet, is a formal listing of the accounting equation as of the last day in the financial period. It reports all assets, liabilities, and owner's equity, what the business owns versus what the business owes. The cash flow statement reports cash inflows and outflows, or receipts and payments for the same period, covered by the other financial statements, and groups these into 3 types of business activities: operating, investing, and financing. These statements link together, but how? The net profit shown on the statement of comprehensive income is conveyed to the statement of changes in equity to calculate retained earnings. The retained earnings balance on the statement of changes in equity goes to the statement of financial position, and the ending cash balance on the cash flow statement should agree with the balance in cash on the statement of financial position. There are also limitations within the financial statements. The historical cost principle states that assets are to be recorded at the price in which they were purchased and may not reflect current market value. Also, for accounting purposes, assets may be depreciated at different rates, which may unfairly represent the present value of the asset. The issue of earnings management can arise within financial statements, where accountants have the ability to choose between accounting methods to manipulate the company's earnings, thus having the ability to change the appearance of financial statements to favor the company. However, in order to maintain consistency and integrity, accounting standards are internationally governed by an International Accounting Standards Board and domestically by the Australian Accounting Standards Board. Furthermore, through the process of auditing, a neutral third party assesses a company's records and confirms the company is representing its financial information in a true and accurate manner.